We'll start with a very important reading of the CFA curriculum that tries to teach us the concept of time value of money. This is reading number 6 of the CFA curriculum. So we'll start by understanding an introduction to time value of money, how to derive the interest rates to be used, the concept of future value and present value of a single sum, calculate the future value and present value of annuities, understand certain other applications of TVM functions, calculate certain complex questions of funding obligations, understand how the amortization of a loan happens, and understand what happens when the frequency of compounding changes. So we say that money has time value. That is, $100 received today is worth more than $100 to be received 1 year later. So if somebody owed you $100, you would rather want your money today than to receive it 1 year later. All of us would. Hence we say that money has time value, or money received earlier is more valuable than money received later. But the question is, what exactly is the time value of money, or how much more valuable is this first $100 that we are receiving today as against the $100 that we are receiving 1 year later? The first $100 can essentially be invested over this 1 year period so as to give us a return, and hence the value of the first $100 at t equal to 1 would be higher than the first $100 or this $100 to the extent of the interest we have earned on the $100 received at t equal to 0. So to answer the question, how much more is the value of the first $100, the answer would simply be the amount of interest, or to the extent of the interest that can be earned on the first $100. So remember that the interest rate R that can be earned over the period on money received earlier is called the time value of money. The higher the rate of interest, the higher the time value of money. The lower the rate of interest, the lower the time value of money. Which brings us to the question that how is this interest rate determined? Or what is the interest rate that should go into the calculation of our time value of money? Now the curriculum gives us various interpretations of interest rates. The first is that the rate of interest is the minimum required rate that we need to offer an investor so that he lends his funds. To explain this concept a little better, let's assume you had $100 and you wanted to deposit that money in a bank. If the bank offers you a 2% rate of interest, would you be interested in lending this $100 to the bank, or would you use it yourself? You'll probably not lend. At 7%, you may consider, but you may or may not lend. So the interest rate that should be used is the minimum rate at which you would lend your funds to the bank. Interest rate can also be thought of as the discount rate that should adequately account for the risk of an investment. So depending on who you are giving the $100 should also have a bearing on how much this rate is. So if this $100 is being invested in a company called Unilever. So Unilever is an FMCG company that makes soaps, detergents, creams, etc. Or if this $100 was given to DLF. DLF, for example, is a real estate company that constructs and sells houses. Where would the rate of interest charged be higher? When you're lending your funds to Unilever or when you're lending your funds to DLF? So if the economy goes into a boom, will you start having a bath 10 times in a day? Or if the economy goes into a depression, will you stop having a bath? No. So FMCG companies, pharmaceutical companies, that is medicines, have a relatively stable demand. The demand for these products doesn't increase or decrease with the economy. Hence, these investments are generally found to be less risky, and we would be willing to lend our money to Unilever for a lower rate because the reliability is pretty high that our money is going to come back to us. If we were lending the funds to DLF, on the other hand, we know that if the economy goes into a recession, DLF can go bankrupt or there may be significant strain on the cash flows. Hence, this investment looks more risky, and if we are lending the money to DLF, we would charge a higher rate. So the second theory says that the discount rate should adequately account for the risk of the investment. The third theory says that the discount rate, or the interest rate rather, is the opportunity cost of current consumption. So please understand, if we have $100, at any point in time with the $100 in our pocket, we have two choices. We can either consume it or we can invest it. If we invest the $100, we will get the interest rate, or we will get a rate of return. If we choose to consume it, then we will give up on this interest rate. So interest rate can be thought of as the opportunity cost of consumption. That is, if you consume, you give up on the rate of return. Or in other words, opportunity cost is that minimum rate of return that needs to be offered so that the consumer gives up his consumption decision. If the rate of return is just 2%, I will not invest, I will rather consume and have a good life now. If the rate of return, on the other hand, is 20%, I may decide to give up my consumption and invest the funds at this rate of return. Remember, opportunity cost is the benefit foregone, or what you give up when you do something or you invest your money somewhere. In other words, it can be thought of as the return that the asset or the money could have generated in its next best use. So these were some interpretations of the interest rate that we described as the time value of money. Please note that correctly applied, all three methods will give us the same answer for the interest rate in a particular application. At your level, you will normally be given the interest rate and you will have to use it and apply it. Generally, deriving the interest rate by one of these methods should not come in the exam, but you do understand the thinking behind how this interest rate is determined and what is the time value of money. Another way of looking at the interest rate is that the rate should at least meet the expected inflation rate. So let's assume an apple today costs $10 and you have $10 that you can invest in the bank. The bank gives you a rate of return of 10% so that your money at the end of 1 year becomes $11. During the same period, that is during the same 1 year, the price of an apple has also increased by 10% and has now become $11. The apple earlier costed $10, it now costs $11. So your money has grown by $11, but what is your real return? Earlier, how many apples could you afford? Just one? Now how many apples can you afford? Still only one? So in real terms, are you any richer? No. Your real return, that is, how many more goods can you purchase, has been 0. So remember, real return is calculated as the nominal return minus inflation. In this case, the nominal return was 10%. However, the inflation in the prices of goods was also 10%. So theory says that the minimum nominal return that has to be offered has to equal the expected inflation. Otherwise, nobody would invest. Why would you put your money in bank? You will rather buy goods or commodities because the prices of commodities are going up by more than the rate of return that you are getting. So the theory says that the nominal rate that needs to be offered should at least meet expected inflation, and then some real return over and above that increases the purchasing power of the investor. So if the bank gave a 20% return, then we would have gotten a real return of 10%. That is, with the same money, we could have bought 10% more apples. Or the nominal rate that needs to be offered is the real rate plus inflation. Now we will study government securities are generally termed as risk-free. That is, the government will not default on its obligations, or whatever the government has promised as a return will definitely be given to the investor. However, as we just discussed, all investments may or may not be risk-free. So if you're giving our money to DLF, or if you're giving our money to corporates, then there may be a chance that the economy does badly or the company performs poorly and is not able to return our obligations when they are due. So if the government or the risk-free rate being offered is so much, that is, the risk-free rate offered by government securities is, for example, 10%, then the rate that has to be offered by an HUL or a DLF or any corporate has to be higher. It has to be higher to account for the various risks that corporates have. There is a risk of default. That is, the borrower will not make the promised payments in a timely manner or will default on its obligations. There is a risk of liquidity. That is, if you are in urgent need of money and you're holding a government security, it may still be easier to sell it because the market is liquid, there's a lot of buying and selling happening. If you're holding corporate bonds, very often the liquidity is not there. It's like you have a real estate property in some far-flung area. You may not just be able to sell it whenever you like. So liquidity risk is the risk of receiving less than fair value if the investment has to be sold for cash quickly. So corporate bonds and other securities tend to have higher liquidity risk than government bonds or risk-free assets. There is also maturity risk, which we'll study in more detail when we study fixed income securities. But generally speaking, longer term investments tend to be more volatile than shorter term investments. So if you are investing in longer term securities, then there is normally a maturity risk premium associated with that. So to derive the interest rate, we can start with the nominal risk-free rate, that is the rate that government securities are offering or government banks are offering. And we can add a premium for the various other risks that the corporates may have. So if the risk-free rate is 10%, let's assume the default risk premium is 2%, the liquidity premium is 1%, and the maturity risk premium is 1%, then the required rate of interest on the security will be 14%. So that's how you can derive the interest rate that will go into the TVM calculation. We began the session by understanding that the rate of interest is the time value of money. If we received our money earlier, we could have invested the money at this rate of interest. So these were a few theories behind deriving the interest rate. For the remainder of the session and generally on the exam, you will be provided with the interest rate or the discount rate, and you will have to apply it in various calculations to derive the present value or the future value, as we'll just calculate. So calculate the future value of a $250 investment at the end of 5 years if it earns an annually compounded rate of return of 9%. So remember, with any question on time value of money or any question involving FE and PV, the first thing to do is to draw a timeline that depicts your cash flows. So in this case, we see that at t equal to 0, we have $250, and we are asked that what will be the value of this amount at the end of t equal to 5. There's nothing additional coming at t equal to 1 or t equal to 2 or t equal to 3 or t equal to 4. So the future value means the value at some future date. In this case, at the end of 5 years. The rate of return or the interest rate or time value of money is given to be as 9%. Please note, very important for any TVM question is the frequency of compounding. So in this case, the rate is annually compounded. Annually compounded implies that the bank pays interest once a year or once every year. We'll study semi-annual compounding, quarterly compounding, and what happens when the frequency of compounding is more than annual. However, to understand the basic concepts, we will generally work with annually compounded rate. So if the bank pays interest once every year, what will be the value of the investment at t equal to 1? We began with $250. So at the end of year 1, we will get our principal back, that is the money we invested, plus we will get some interest. So this $250 is the principal that we invested, and the interest, please remember, is given as the principal into the rate of interest into the time. So the principal was $250. The rate of interest, we will generally call it R. In this case, R is equal to 0.09. And the time that it has been invested for is 1 year. So at the end of year 1, the $250 have become, 250 will come out common into 1 plus R. The 1 represents the principal coming back, and the R represents the additional rate of interest that we are getting. For the remainder of the question, I will replace 250 with present value so as to derive a general formula. Had we invested PV at the end of year 1, the PV would have become PV into 1 plus R. At t equal to 2, that is for the second year, how much money is invested with the bank? Is it 250 or is it 250 into 1 plus R? We have gotten our interest at t equal to 1, but we haven't withdrawn anything. So for the second year, PV into 1 plus R is invested with the bank. So at t equal to 2, we will again get our principal back, that is PV into 1 plus R. Plus we will get some interest, that is the principal, into the rate, into the time, that is again 1 year. So here again, PV into 1 plus R will come out common, and we'll have 1 from the first term plus R from the second term. Our amount at the end of year 2 would become PV into 1 plus R to the power 2. Similarly, at the end of year 3, year 4, at the end of year 5, we can calculate that $250 or an amount PV would become PV into 1 plus R to the power 5, or that will be the future value of an amount PV invested at the rate of R for the next 5 years. More generally speaking, an amount PV invested for n years would have a value equal to PV into 1 plus R to the power n at the end of n years, that is at t equal to n, given r is an annually compounded rate of interest, that is bank pays interest at the end of every year. So let's substitute the values in our question and try to calculate this answer. So it will be 250 into 1 plus 0.09 to the power 5, that is 250 into 1.09 to the power 5. So we'll use our calculators to solve this question. Now the first thing that I need you to do is that if you see 2 decimal places on your calculator, we would want to change this to 5 decimal places. So rather than 0.00, we'd like to have 5 decimal places. So please press second on the calculator, that is the second button of the first column, and press dot. Pressing second makes you access whatever is written on top. It's like the shift button. So we are accessing the format sheet. So as we press second and dot, we will see DEC equal to 2 on the screen. Now we want 5 decimal places on our screen, so we will simply press the button 5 and press enter. As we press enter, we'll see DEC equal to 5 with 5 decimal places flashing on the screen. You can now simply clear out. Whenever I say clear out, it is the last button of the first column. So press clear out twice and you'll see 0.00000, that is 5 decimal places on the screen. We now want to calculate 250 into 1.09 to the power 5. So we will first calculate 1.09 and we want to raise this to the power 5. So we'll press y to the power x and we'll press 5. So that will do 1.09 y to the power x 5 and press equal to. We'll see 1.5386. Store this in the memory register 1. So press the button store and press 1. We're storing it just in case we make a mistake, we need this calculation again, we don't have to recalculate it. So we stored it in the memory register 1 and we will now multiply it with 250. So multiply with 250 and then press the button equal to. So we see that the future value comes out to be $384.66. We will store this in the memory register 2 just to compare it with the other method that we'll just study. So again, press the button store and press the button 2. To recall any of the values that you stored earlier, just press the button below store, that is called recall. So recall 1 and you will see the 1.53 stored earlier. Recall 2 and you will say the future value that you also stored earlier. That's the first method of calculating the future value. That's called the brute force method. In simple questions, you can simply just multiply and calculate. However, in more complicated questions, you will appreciate the use of the time value of money sheet that we will understand next. So the third row of the calculator is referred to as the TVM sheet. So please note it has 5 variables: N, I by Y, PV, PMT, FV. This is called the TVM sheet and we'll understand how to use this next. By far the most important sheet and the most important buttons of the calculator that you need to learn. So remember, N refers to the number of compounding periods there are, not the number of years. So when is the number of compounding periods? We are doing the question with annual compounding, so our number of periods is the same as the number of years. I by Y is the interest rate per compounding period. PV is the present value. PMT stands for payment per period. And FV stands for future value. The property of the TVM sheet is that if you give it any 4 inputs, it will calculate the 5th one for you. So any 4 inputs given, the 5th one will be calculated. So in our question, what is n equal to? 5 years or 5 compounding periods? The interest rate per period is equal to 9% or 0.09. So please just enter 9, don't enter 0.09. The calculator knows that the interest rate is a percentage. The present value to begin with is 250. The payment per period is nothing. So there is nothing that we are withdrawing or we are putting in at the end of each of these 5 years. So please note that the PMT is the payment per period at the end of the period. FV stands for future value. That is what we need to calculate. So let's input the values in the TVM sheet and let's calculate the answer. The number of compounding periods is 5. So press the button 5 and press N. So remember, to assign any value to the variable, first press the value and then press the variable. Press 9 and then press I by Y. So you'll see I by Y equal to 9. Press 250 and then press PV. Press 0 and then press PMT. So we've given the 4 inputs. If you want to check what you have entered or if you think you've entered anything wrong, don't just directly press that variable. That will assign whatever is flashing on the screen to that variable. So if you want to check what you have entered, first press the button recall and then N. Recall I by Y, recall PV, recall PMT. So we've correctly inputted the 4 variables. We now want to calculate the future value or the 5th variable as the time value of money sheet will give us. So press the button compute and press FV. So we'll see FV comes out to be 384.65599. You also see a star on top. That basically indicates that there were more decimal places and the calculator has had to round off. And never mind this negative sign that is coming. It just means that if you receive $250 from somewhere, we entered 250 as positive. That means it is a cash inflow into our portfolio. So if we receive $250, we will need to pay back $384.655 if we are receiving the money at the rate of 9%. Had we entered PV as minus 250, so you can again press the button. You can first clear out and press minus 250. So press the button 250 and then press plus minus. So it will become minus 250 and then press PV. So the PV is now entered as minus 250 and then again compute FV. You will see that FV is equal to $384.65599. So it comes out to be positive now. So never mind the negative sign, and we can recall what we stored in the memory register. So we stored this value in the memory register 2. So recall 2. You see it's the same value that we calculated from a brute force method. So the time value of money does give us the right answer. You can recall again the values that you inputted. Please remember that turning the calculator on and off will not clear this sheet. All values will still be there. I can recall FV, I can recall PV, and I can still see the values. If you want to clear these values out, then you will first have to be in the TVM sheet. That is, recall any of these values. So that you'll be in the TVM sheet and then press second and press clear TVM. That is second and FV. So you see clear TVM and that will clear out all values in the TVM sheet. When you recall now, there will be nothing stored. So that's how we can use the TVM sheet to do the first most basic calculation. We will soon use this sheet in more advanced calculations where it will be indispensable. So we just studied that the future value of a single sum of money is equal to present value into 1 plus r raised to power n, where n is the number of years and r is an annually compounded rate. Let's now try to calculate the present value of a single sum of money. So, given a discount rate of 9%, calculate the present value of a $1,000 cash flow that will be received 5 years later. So, at t equal to 5, somebody is willing to give me $1,000. How much is he effectively giving me today, or what is the value of the $1,000 today, also called the present value? So, if somebody gave me $1,000 today, how much would it be worth at the end of 5 years? Given that the rate of interest is R. I could put it in a bank, earn a rate of R for 5 years, and that 1,000 would become 1,000 into 1 plus R to the power 5. So can we say that whether somebody gives me $1,000 today, or he gives me 1,000 into 1 plus R to the power 5, 5 years later, he is effectively giving me the same amount of money? Because 1,000 today, I could myself invest and make it this amount at t equal to 5. Now the question is, if somebody is giving me $1,000 at t equal to 5, then how much is he effectively giving me today? Can we say that he's giving me an amount equal to 1,000 upon 1 plus r to the power 5? We'll try to apply the same argument that if somebody gives me 1,000 upon 1 plus r to the power 5 today, then how much would that money become after 5 years? At t equal to 5, it will be the amount today into 1 plus r to the power n. So it would be 1,000 upon 1 plus r to the power 5 into 1 plus r to the power 5, or it would become $1,000. So $1,000 at t equal to 5 is the same as 1,000 upon 1 plus r to the power 5 today. That is the concept of present value. Please remember, the present value, and we can deduce it from this formula as well, of a single sum of money is equal to the future value upon 1 plus r to the power n, where r is an annually compounded rate of interest. So let's try to apply to this question. So we're getting $1,000 at the end of 5 years, and the rate of discounting is 9%. So the present value would be given as 1,000 upon 1.09, or 1 plus 0.09 to the power 5. Again, we'll calculate this using the brute force method first, and then using the time value of money sheet. Let's first calculate 1.09 to the power 5. So we'll use the function y to the power x 5 and press the button equal to. So it comes out to be 1.53862. Let's store this value in the memory register 1, and we need to compute 1,000 divided by 1.09 to the power 5. So let's press the button 1,000 divided by recall 1 will give us the answer. That is 649.93139. Just store this in memory register 2 for future use if need be. And we will now also calculate this with the help of the time value of money sheet. So please recall that if you give it any 4 inputs, the 5th one will be calculated for you. The 3rd row of the calculator is called the time value of money sheet. So for our question, what is the number of periods equal to? It is the same as the number of years, that is 5. The interest rate per period is given to be 9%. The present value is what needs to be calculated, so we'll ignore that. Any payments that are coming or going out of our portfolio in each of these 5 periods? No, so we'll enter the TMT as 0. The future value is $1,000. That's the amount that we are getting, and we are asked to compute the PV. So let's do it on the calculator. 1000 is the future value. Press 1000 and then press FV. 0 is PMT. Ignore PV for now. We need to compute that. 9 is the interest rate per period. And 5 is the number of periods. So we've given the calculator 4 inputs. It will calculate the fifth one for us. So we press the button compute and press PV. So we get minus 649.93139. Now guys, you can ignore the minus sign for now, or you can just think of it as that if you are to receive $1,000 5 years from now, we enter it as positive. So we are implying that this is a cash inflow. So if I want to receive $1,000, I need to pay $650 today, or I need to invest $650 today. That's what the negative sign denotes. Remember that PV and FV, or PV and PMT, the present and the future cash flows will always have opposite signs. So we can just recall what we stored in the memory register 2 and verify it's the same value that we've calculated using the time value of money sheet. So pretty straightforward questions, but very important to understand the use of the calculator nonetheless. So once again, the values that we needed to enter. Now guys, whenever we hear the term ordinary annuity, remember, it's an annual set of payments coming at the end of periods, or coming at the end of the year. So an annuity means a payment every year, and ordinary means that the payment is coming at the end. So what is the future value of an ordinary annuity that pays $150 per year at the end of each of the next 15 years, given the investment is expected to earn a 7% rate of return, or the discount rate is 7%. Now, in any question involving time value of money, the first thing we do is we draw a timeline. Now, a timeline depicts the cash flows and the times at which they are coming. So let's try to draw the timeline for this question. So at t equal to 0, am I getting anything? No, it's an ordinary annuity. It makes payments at the end of the year, so nothing here. At the end of the first year, I get $150, or I pay $150. So never mind the minus sign here, guys. You can assume that you're making the payment, or you can assume that you're receiving the payment. Either ways, the future value will come out to be the same. At the end of the second year, I again pay $150, so on and so forth till the 15th year. So this is just a depiction of the cash flows of the ordinary annuity. Question asks, compute the future value. Now, whenever we have a question asking us to compute the future value, it means the value at the end of the last period. So if there were 10 periods, then at the end of year 10, if there were 15 periods, then it will be the end of year 15. So it is the end of the last period. That is what the future value is at. So how will we compute the future value of this annuity? Now, a good method would be to see the 15 payments one at a time, compute the future value of each payment, and sum them all up to get to the future value of my annuity. So what will be the future value of the first payment of $150? Please note that this $150 is not coming at t equal to 0. It's coming at t equal to 1. So how many years does it have to be invested, or does it have to earn interest? 1, 2. So till t equal to 3, we have just 2 periods. Till t equal to 15, we will have just 14 years over which these cash flows are actually invested. So the future value will be the present value into 1 plus r raised to the power n. N in this case is 14. Likewise, for the second cash flow, it's not coming right away, it's coming 2 years later. So it'll get invested only for 13 years. Hence the value will be 150 into 1 plus r to the power 13, so on and so forth for all cash flows. We can compute the future values, sum them up to get to the future value of the 15 payments. What will be the future value of the last payment? What is the future value of $150 at t equal to 15, and they're coming at t equal to 15? It'll be 150 into 1 plus r to the power 0, as they don't have any time to get invested, or the same as 150. So if we sum them up, we will get to the future value of the annuity. If we drew it by the brute force method or manually for each payment, it'll take too long. So this is where the time value of money sheet really starts to become useful. So let's try to give the TVM sheet 4 inputs as always, and it'll calculate the fifth one all for us. So do we know n in this question? Yes, it's a number of 15. Do we know what I by y is? It's given to us as 7%. Do we know about the payments every period? Yes, there are a number of 150. Doesn't matter if you enter plus or minus, we'll just enter 150 positive for now. The present value is given to be 0 since there's no payment right at the beginning. And we're asked to compute the future value. Now we've understood conceptually what has to be done. This is what conceptually has to be done. Each payment has to be taken till t equal to 15 and summed. However, using the TVM sheet makes this calculation very easy for us. So let's go back to the calculator, and so you can first clear out, then press the button 15 and press N. Now please note that you don't have to clear the previous values. They'll automatically get overwritten when you enter the new values. So don't worry about what has already been entered. Press the button 7 and then press I by Y. Press 150 and press PMT. Press 0 and then press PV. And we need to compute the value of FV. So the FV comes out to be 3769.35 negative. Had we entered these values at minus 150, the FV would have come out to be positive 3769. So if we take money from somebody, we have to give them back. If we invest money with somebody, we will receive 3769.35. So that's the future value of this ordinary annuity. Similarly, we can calculate the present value of an annuity. So the question asks us to compute the present value of an annuity that pays $200 per year at the end of each of the next 13 years, and the discount rate is 6%. So we'll work along the same lines. First, draw the timeline for the cash flows. So from t equal to 1 to t equal to 13, since it's an ordinary annuity, it makes payments at the end of the year. We get payments of $200 per year. So conceptually speaking, how will we solve this question? We know the TVM sheet will make it very easy for us, but please understand what is actually happening inside the TVM sheet. So the first cash flow comes at the end of year 1. If I am to compute the present value or the value at t equal to 0, will it be lesser than 200? Yes, it will be to the tune of 200 upon 1 plus r. The second cash flow is coming at the end of year 2, so the value will be 200 upon 1 plus r to the power 2, so on and so forth. The last cash flow will have a value of 200 upon 1 plus r to the power 13. R is given in the question, and so are the other inputs. So we'll enter N as 13 in our TVM sheet, I by Y as equal to 6. Payments every period at the end of each of these 13 periods are given to be 200. What is the future value in this question, guys? What am I getting at the end of t equal to 13? That is the meaning of future value. I'm getting $200, but please note that I've already told the calculator about this 200 when I said PMT is 13. Calculator knows that there are 13 payments of 200 coming. So if you enter again 200, it will assume there is 200 plus 200 coming, which is not the case. So do not enter FE as 200, enter it as 0. And then press the button compute and PV to get to your present value. So we'll press 13 and press N, press 6 and press I by Y, press 200 and press PMT, press 0 and press FV, compute PV. So the present value comes out to be 1770.53659. So we'll now start to complicate things a little bit. The question says, what is the present value of $4 end of year payments if the first payment is to be received 3 years from today and the appropriate rate of return is 9%? So let's try to draw the timeline for this question first and see how our cash flows are coming. So we receive 4 end of year payments. But the only complication is that the first payment is not coming at t equal to 0 or t equal to 1. The first payment comes 3 years from today. So t equal to 1, t equal to 2, t equal to 3. This is where the first payment of $100 comes. And then there are 4 total end of year payments. So from t equal to 3 to t equal to 6, we get 4 end of year payments. And we need to compute the present value of this annuity. So present value means the value at t equal to 0, the value right here. So what will be the value of the first cash flow? It will be 100 upon 1 plus r to power 3, since it's coming 3 years later. The second cash flow comes 4 years later, so on and so forth. We can manually discount each cash flow and compute the value at t equal to 0. The only problem with this method is that though conceptually right, it'll take us too much time because we don't have any direct functionality on the calculator to input this gap of 2 years and calculate the value for us. So if we are to use the time value of money sheet, we will have to slightly manipulate the question. Or why don't we think of time t equal to 2 as t equal to 0 for the time being, and then we will just assume that there are $400 payments coming for the 4 subsequent years, and we'll try to calculate the present value of this annuity at t equal to 0. That's what we've done in the previous question. And the advantage now will be that we can simply use the TVM sheet to do this. So if you're to calculate it in this fashion, then I just need to enter n as 4, I by y as 9, that's given in the question, PMT of 100, there are $400 end of year payments coming, FV as 0, nothing additional coming at the end, and compute PV. Now this step, however, will not be the solution to the problem, because even though it will be the present value, it will be the value at t equal to 2. So as a next step, we would have to discount this value 2 periods back again and compute the value at t equal to 0. So first let's do the first calculation and compute the value at t equal to 2. So let's clear out the calculator. Enter 4 and press N, 9 and I by Y. Ignore PV, press 100 and press PMT, press the button 0 and press FV and compute PV. So PV comes out to be minus 323.97, or the present value of these 4 cash flows is so much. Let's store this in the memory register 1 in case we need it in the future, and we know that we will need it in the future. And let's go back to our question. So the value at t equal to 2 is equal to about 323.9. And this is not the solution because we need to discount it back another 2 periods. What will we do for that? The number of periods now will be 2. The interest rate remains the same as 9. There are no payments coming every period. Please note, on the 2 periods, we're not getting any fixed amount of cash flow at the end of each year. So enter PMT as 0. The future value will now be the value that I saved earlier. So I'll just recall 1 and enter FV because this value has already been stored with me with the calculator. And compute PV. So let's do it. Press the button 2 and press N. Press 9 and press I by Y. Press 0 and press PMT. First, recall 1. You'll get back your stored value of 323.97. And then press FV. Compute PV to get to the final answer, that is 272.68074. Just to refresh, if you want to check any of the values that you've entered, supposingly you're not getting this answer on your screen, you may want to check what you have entered. So just recall N, first press recall I by Y to verify that all the values that you've entered are correct. To see what all the memory registers contain, just in case you want to have a look at what are the different values you've stored in different registers, you can press the button second and press memory. So memory is on top of button 0, and you will see that in memory register 0 we've stored a value of 0. If I scroll down, in memory register 1, please remember I stored 323.97. In memory register 2, sometime earlier, I stored the value of 650 approximately, and 3, 4, 5, 6, 7 are all empty. If I want to clear all items in the memory, then while I'm in the memory sheet, that is while I've pressed second and mem, that is I'm in the memory sheet, press the button second and clear out. That is, you're accessing clear work. So press second and clear work. All memory items will become 0. Just in case you want to do that. So you can clear out and you'll be out of the calculator. 272.68. You can have a look at the solution in detail. Now, a very interesting financial instrument is called a bond, and we'll understand the cash flows of a bond with the help of this example. So, a bond will make coupon interest payments of 70 euros. That is 7% of its face value at the end of each of year, and will also pay its face value of 1000 euros at maturity in 5 years. If the discount rate is 8%, what is the present value of the bond's promised cash flows? So a bond or any fixed income instrument is called so because it gives us a fixed stream of cash flows. These cash flows are generally broken up as coupon payments and principal payments at maturity. So this bond, for instance, pays us a coupon payment of 70 euros every year for the next 5 years. Let's draw the timeline and depict the cash flows. And at the end of 5 years, it will also pay its face value. This face value is also called as par value or principal at maturity. So at maturity, or at t equal to 5, we not only get the 70 of coupon, but we also get the $1,000 of face value. We'll study more in the review on fixed income securities. Right now, let's just understand the time value part of it. Question asks us to compute the present value of the bond's promised cash flows. Once it does that, it's no different from any other question related to time value of money. The present value of each cash flow will simply be the cash flow discounted back by the number of years away it is. So this will be 70 upon 1 plus r to power 1. Cash flow coming at t equal to 4 will be 70 upon 1 plus r to power 4. And the entire 1070 will be discounted back by 1 plus r to the power 5. Let's use the TVM sheet again and solve this question. So what is the number of periods? 5. The interest rate every period. Please note that this interest rate per period, or this discount rate, may be different from the coupon rate, which is 7%. So please don't take the coupon percentage as the same as the discount rate. The discount rate will be explicitly mentioned or given. It is also called the yield to maturity, as we will study in the chapter on fixed income securities. So the interest rate is given to be 8%, or into I by Y is 8. The payment every period is $70. And now what will we enter as FV? Over and above the $70 that I've already told the calculator, I'm getting a value of $1,000. So we'll enter the future value as 1,000 and compute PV. Let's do it. So N is equal to 5. Press the button 5 and press N. I by Y is equal to 8. Press 8 and press I by Y. We need to compute PV, so ignore that. $70 is the annual payment every year, and $1,000 comes additionally at t equal to 5, or at the end of the last period, that is at maturity. So once we've entered the values, we can press the button compute and press PV, and we'll get that the present value of the cash flows comes out to be 960.07. Please note, had we entered the payments as well as the FV as negative, that is, we assumed that it was cash outflows, PV would have come out to be positive, or a cash inflow. Right now, we are assuming that 70 and 1000 are both cash inflows because we are entering them as positive, and hence our PV is coming out to be negative. Meaning that if we pay $960 today, we should get 70, 70, 70 and 1070 over a 5-year period. In the solution in detail. An annuity due is different from an ordinary annuity in that the payments are made at the beginning of the period. So if the question says annuity due, you know that the payments are coming at the beginning of the years, not at the end of the years. So let's see how that makes the question a little different. So what is the future value of an annuity that pays $100 per year at the beginning of each of the next 3 years? So 3 payments are coming, but at the beginning of each of the 3 years, if the cash flows can be invested at a rate of 10%. So let's draw the timeline first. So 3 payments, first coming at the beginning of the first year, the beginning of the second year, and the beginning of the third year. So t equal to 0, t equal to 1, t equal to 3, and we're asked to compute the future value of these payments. I'm sure all of us understand now how we would do it conceptually. So the first cash flow gets invested for 3 years, second one for 2 years, third one for 1 year, so on and so forth. But the question is that how do we solve this on the calculator using the TVM sheet? So if I enter n as equal to 3, I enter I by y as 10, I enter PMT as 100, PV as 0, and I compute FV, will I get the right answer? If I just give these standard inputs, the calculator will assume that, okay, there are 3 periods, it's fine. The interest rate is 10%, which is also okay. The payments are of $100 each, which is also fine, but please note that unless otherwise specified, the calculator will assume that these 3 payments are coming at the end of the 3 years. So calculator, as of now, will assume that there is a $100 payment coming at t equal to 1, another $100 coming at t equal to 2, and $100 coming at t equal to 3. But that's not the case. We need to tell the calculator that the 3 payments of 100 this time are coming at the beginning of the years. So before I press compute PV, we need to tell the calculator that these payments are coming at the beginning of the periods. So press second and press PMT, and then press second and press enter. We'll just show you on the calculator. So we have 3 periods, so press 3 and press N, press 10 and press I by Y, press 100 and press PMT, press 0 and press PV. But before you compute FE, you need to tell the calculator that these payments are at the beginning of the periods. So press the button second and press PMT. You will see END end flashing on the screen. So we need to change this value to the beginning of periods. So we'll press the button second again and press enter. That is set the value to beginning. And you can toggle as many times. If you press second and set again, it'll change back to end. At the moment, we want it at the begin mode. So once you see BGN flashing on the screen, you can clear out. The values will already be in your calculator that you just entered. You can recall and check them. And then compute FV. So the future value comes out to be $364.1 of these 3 cash flows. So a very important property, that is the beginning mode, that we learned with the help of this question. Here's a detailed solution, $364.1. So we'll do one more question, guys, slightly different though. So if you deposit $1,500 in the bank today and at the beginning of each of the next 3 years, so 1,500 goes right at t equal to 0, and then the beginning of each of the next 3 years, we again get $1,500. Question asks, how much will we have 6 years later? So not at t equal to 4 or t equal to 3, but rather 6 years from now, how much will be the worth of those 4 payments, first one today, and the remaining 3 at the beginning of each of the next 3 years. So let's draw the timeline first. So the first cash flow comes at t equal to 0, and then 3 subsequent cash flows at the beginning of the next 3 years. So beginning of the second year, beginning of the third year, and beginning of the fourth year. So these are the 4 cash flows that the question mentions. And then the value asked is not at the end of t equal to 4 or t equal to 3. The value is asked at the end of t equal to 6. So please think a second, pause the video as to how you're going to solve it. In fact, solve the question. You're very well equipped now. The brute force method would take too long. We would have to compute the future value of each of these cash flows at t equal to 6. See the time that they're invested and then sum it up. Likewise for the second, the third, and the fourth cash flow. So even though we understand this conceptually, we would like to take help of the calculator to make the calculation a little simpler. So if we use the time value of money sheet and we give the inputs as n equals 4, I by y, which is given to be equal to 8, PMT equals to 1500. Now since I've entered n as 4 and PMT as 1500, calculator knows that there are 4 payments of 1500 coming. But we know that the 4 payments are not coming at the end of the year. So before I compute, I will change the mode of the calculator again back to the begin mode to tell the calculator that the 4 payments are coming at the beginning of the 4 years. And because I've done that, I don't have to enter anything separately as PV. So PV can be entered as 0 because the 4 payments have been entered into the calculator anyways. But yeah, change the mode to the begin mode before you solve the question. And compute FE. Once I compute FE, guys, remember FE is always the value at the end of the last period. That is at the end of t equal to 4. So this is the value that the calculator will compute for me. And to get to the final answer, I will have to compound it 2 periods forward. That is, whatever this FE is into 1 plus r to the power 2 to get to the final answer. Let's do it on the calculator. Press 4 as n, press 8 as I by y given in the question. 1500 is the PMT, but make sure that you're in the beginning mode. See, the calculator says BGN on top, which means we already are in the beginning mode. But we can verify once again. So press the button second and press PMT. You'll see BGN written. If you press second and enter, which you don't need to in this case, it will change to the end mode. That is, will tell the calculator payments coming at the end of the period. Change back to the beginning mode. And you can clear out. Enter 0 as PV because there are no further payments coming. And compute FV. So this FV is the value at the end of t equal to 4. We will store this in the memory register 1 because we know we will need it in the future. That is, we'll need to compound this for 2 more years. So how do we compound it for 2 more years? This FV is already there. N will be entered as 2. I by y remains the same as 8. PV, the new PV will be this FV that we just calculated. So recall 1 and enter PV. No payments coming in these 2 periods. And then compute FV. This FV now will be a final answer. So press the button 2 and press N, press 8 and press I by Y. Recall 1 and press PV. No payments coming in the 2 years and compute FV. So the FV comes out to be 8514.60 and that is the final answer. That is the value at t equal to 6. Have a look at the detailed solution. So just like we calculated the future value of an annuity due, in the same manner we can calculate the present value of an annuity due. So given a discount rate of 8%, what is the PV of a 3-year annuity that makes a series of $1,000 payments at the beginning of each of the next 3 years starting today? Please do the calculation on your own, guys, and you can verify your solution as given in the slide. Should get the answer to be 2783.26, the same concept that you will carry forward. Now, a perpetuity is an annuity forever. So it is a fixed series of cash flows that keeps coming till infinity. Assume the preferred stock of Alstom Corporation pays $9.5 per year in annual dividends, and the company plans to follow this dividend policy forever. In fact, this is generally how we look at preferred stock. We'll study it more in equity valuation, but a preferred share is like debt in that it gives us a fixed cash flow, but there is no time to maturity like bond or like debt. So this fixed cash flow is generally assumed to be coming forever. The discount rate is 8.5%. Question asks to compute the value or the present value of this instrument. So let's first draw the timeline of the cash flows. So at t equal to 0, I'm not getting anything. At t equal to 1, the first payment comes of $9.5. T equal to 2, another 9.5. So on and so forth till infinity. So what will be the present value of the first cash flow? It would be 9.5 upon 1 plus r. The second cash flow would be 9.5 upon 1 plus r to the power 2. So on and so forth. The cash flow coming at t equal to infinity would have a value of 9.5 upon 1 plus r to the power infinity. Now guys, a geometric progression is a series in which the next term is the same as the previous term multiplied by a common ratio. So is this series a geometric progression? The set of cash flows from t equal to 1 to infinity that we see. If yes, what is the common ratio? So we can verify that each term is the same as the previous term multiplied by 1 upon 1 plus r. The second term is the first multiplied by 1 upon 1 plus r, so on for each subsequent terms. Now, the sum of a geometric progression till infinity is given as first term divided by 1 minus the common ratio. Please note guys, and this you don't need to know this proof. The CFA is not a maths test, but still it doesn't harm for us to understand. The books normally will not mention this calculation is in as much depth, so try to listen carefully. So the first term of our series is what? It is 9.5 upon 1 plus r, and we just analyze the common ratio as 1 upon 1 plus r. So the sum of this GP would be first term upon 1 minus the common ratio. Now it can be written as 9.5 upon 1 plus r upon 1 plus r minus 1 upon 1 plus r. This 1 will get cancelled. The 1 plus r will get cancelled from both denominators. And so what will be left is 9.5 upon r. In general terms, please remember that the present value of a perpetuity is given as the cash flow divided by the discount rate. In this case, the cash flow is $9.5 and the discount rate is 0.085. So we can simply do this on the calculator. 9.5 divided by 0.085 comes out to be 101.764. Using the Alstom preferred stock described in the preceding example, determine the rate of return that an investor would realize if she paid $75 per share for the stock. In this question, the price is given to us and we are asked to compute the rate of return R that is implied in the share. So please recall what the cash flow was every year, $9.5. And we proved that the price or the present value is cash flow upon the rate of interest, or the implied rate will be nothing but the cash flow divided by the price. So 9.5 is the cash flows that I'm getting from the preferred stock, and this investor is paid $75. So she is effectively enjoyed a return of 9.5 divided by 75. That is 12.667%. So we've been using the TVM sheet up till now to calculate the future value and the present value, but we learned that if you give the sheet any 4 inputs, it'll calculate the 5th one for you. So we can use it to calculate essentially any of the 5 variables that we studied. So let's read the example. That suppose you have $1,000 ordinary annuity earning an 8% return. How many annual end of year $150 withdrawals can be made? So the question essentially asks that I've saved $1,000 at retirement and I'm going to be needing $150 every year for meeting my living expenses. At a rate of interest of 8%, how many such $150 withdrawals will I be able to make? So we are now asked to compute the number of years that the withdrawals can be made, and hopefully the other 4 inputs of the TVM sheet would be given to us. So N is now what we have to calculate. The payment at the end of each year that we want to withdraw is $150. We have saved at the beginning $1,000, and now please make sure that you cannot enter the PMT and PV as both positive. So you either enter PV as negative, that is, you're implying that you've invested $1,000 and now you're receiving $150 every year, or you enter PV as positive but then enter PMT as negative in order to get the right answer. So the interest rate per period is given to be 8% in the question, and I don't want to be left with anything at the end, so FV is equal to 0. And we can compute N. So let's try to do it on the calculator. 150 is the PMT, 1000 rather minus 1000 is PV. So first press 1000 and then press the button plus minus to make it minus 1000, and then press PV. 8% is the interest rate every period. I don't want to be left with anything in the end, so 0 is FV. And compute N. But before you press compute N, just ensure that your calculator is in the end mode. We see BGN flashing, that is, we haven't yet reversed the mode of the calculator. So press second and press PMT. We see BGN written. Our payments are now being withdrawn at the end of every year, so we'll press second and set, change it back to the end mode, clear out, and then compute N. So with $1,000 of savings at 8% rate of interest, I can withdraw $150 for approximately 10 years or 9.9 years. So similarly, you can use the TVM sheet to calculate any of the 4 variables, not just PV and FV. So we see N as 9.9 in this case. Let's do one more example and let's cement the concept of FV and PV, so that now we'll be able to solve any question along these lines, no matter how twisted it is. as long as we understand the basic concepts and we know the basic functionality of the calculator. So the question says that assume a 33-year-old investor who wants to retire 25 years later at the age of 58. She expects to earn 12.5% on her investments prior to her retirement and 10% thereafter. How much must she deposit at the end of each of the next 25 years so as to be able to withdraw $20,000 every year at the beginning of each year for the 30 years in her retirement from the age 58 to 88? So interesting question. She's going to retire 25 years later. We need to tell how much should she save today so as she's able to live through her retirement. Let's first draw the timeline for this question. So t equal to 0 is when she is 33 years old. She wants to retire 25 years later, that is at t equal to 25, at which time her age will be 58. She expects to earn 12.5% in this period. And the question asks us that how much should she save at the end of each year for the next 25 years in order to be able to withdraw $20,000 per year. So she's going to withdraw $20,000 per year for the next 30 years, that is from t equal to 25 to t equal to 55, at which time her age will be 88. And these withdrawals will be happening at the beginning of each of the years. So the first is going to happen at the beginning of the 26th year, that is at t equal to 25, a withdrawal of 20,000. Then again on the 26th, that is the beginning of the 27th year, beginning of the 28th year, and finally beginning of the 55th year, another withdrawal of 20k has to happen. In the second period, or in the time during her retirement, her investments will be moved to less riskier bets and she expects to earn only 10%. So how much is this amount X that she must deposit every year for the next 25 years so as to be able to make these withdrawals of 20k in the 30 years of her retirement? The withdrawals happen at the beginning of the year. So if we first calculate the present value of all these 20k cash flows at t equal to 25, then we would know that what must be her savings at t equal to 25 such that she is able to fund this annuity, or she is able to make withdrawals of 20k every year for the next 30 years. So let's see, how much must she have at t equal to 25 so as to be able to live her retirement. So she's gonna withdraw payments for 30 years. The interest rate is given to be 10% in this period. The payments that she wants to withdraw are 20,000. But please note, these payments are at the beginning of the year, so we need to tell the calculator that. And she doesn't want to leave a bequest, or she doesn't want anything in the end, so the future value is 0. And we can compute PV. So we need to save for 30 years. The rate of interest is 10%. Ignore PV, we want to calculate that. Payments are to the tune of $20,000 and 0 is FV. Before I compute PV, please make sure that you change the calculator to the begin mode. Second PMT and second enter. We are in the beginning mode, and now compute PV. So she needs about $207,400 at t equal to 25 in order to be able to make these withdrawals for the rest of her retirement. So we'll save this value in memory register 1 since we're going to need this later on, and we'll go back to our question. So now we've calculated how much money she needs at t equal to 25, that is this PV that is required here I just calculated. The next point asks that how much should we be saving every year for the next 25 years so as to be able to accumulate this value. So we are now saving for 25 periods at a rate of interest of 12.5%, and we need to have a future value of about $207,400. This value has been saved in memory register 1, so I'll just recall 1. If we compute the payments, then we've essentially solved our problem. This is the amount that she needs to save every year for the next 25 years. But please remember that you must bring the calculator back in the end mode because these savings are happening at the end of each period. Let's do it. 25 is our end now because we're saving for 25 years. 12.5 is the interest rate per period. We don't have anything to begin with, so the present value is 0. So she has no savings right now. She's going to start saving to accumulate a total value of $207,000 in the future. So we'll recall 1. Please note it comes out to be 207,392.1183 and press the button FV. You can let this negative sign be. If you let it be, your PMT will come out to be positive. If you change it to positive, the PMT will come out to be negative. So $207,400 is what she needs as FV, and I want to compute the payments required to do so. So I have 4 inputs. The 5th one will be calculated for me, but before doing that, please remember to change it back into the end mode. So I press second and PMT, second and enter. I'm back in the end mode. Clear out, compute PMT. So she saves $1,440 today for the next 25 years. Then she will be able to fund her retirement, in which she wants to withdraw $20,000 every year for 30 years. So with this question, guys, we've pretty much understood all concepts of present value and future value of money. Make sure you practice many questions of these types so that you become fluent with the calculator and it becomes second nature to you. Thank you so much, and see you next time.